All right, then, thank you. So this is the question we were solving last time, which we couldn't complete. So right now, let me just quickly go through the question again, so that we'll be at par. Let me confirm something. Okay. Yes. In the question, you are required to calculate the expected return, variance, and standard deviation of each security. And that's what we're able to solve. Last time we have completed that. Then in B part, you are to calculate the covariance between the two securities and the correlation coefficients. During my last explanation with you, we said that to measure the relationship between securities in the portfolio, you need to calculate correlation coefficients, because correlation coefficient represents measures the relationship between securities in the portfolio. When you talk about covariance between securities, it's simply the linear relationship that exists between two variables. Therefore, there is no how you want to calculate correlation coefficients that you will not need the knowledge of that you're not going to need covariance. Therefore, as far as this number B is concerned, examiner wants you to calculate covariance between securities. Then number C, to get my covariance in number B is not, so what I will do is to just, okay, let me just read through the requirement, then I will switch to the working notes. Then number C, you are told to calculate the return of the portfolio of the investor, and also what are the returns of his portfolio for each of the possible states A, B, and C. Calculate the expected return, variance, and standard deviation. Now, in this number C, what the examiner is simply telling you is to calculate the expected return of the portfolio and the risk of the portfolio. So we keep it on one side. Then number D, you are asked, using the general formula for mean return and variance of a two portfolio, recompute the mean. Again, what you have in C and D is the same. You are supposed to calculate expected return. Okay, you are supposed to calculate the expected return of the portfolio as well as the risk of the portfolio for the two. However, in the D part, examiner was specific by asking you to use general formulae. You are supposed to use formula for D. So if you have to use formula for D, then it means that for that C, you are supposed to use tabular method to calculate the same thing. All right. Then number E, examiner is asking you, would your answer to D above be different if the correlation coefficient had been +1, plus 0.50, or -1? So what this means is that when you want to calculate the risk of the portfolio, where you have correlation coefficient R, okay? So examiner has given you the R. These are the R's. So what that means is that in your formula to calculate the risk of the portfolio, you are going to be changing your R to the 4 options as given to you. All right. Examiner want to see at the end of your calculations, what conclusion can you draw? What conclusion can you draw? So that's what the examiner wants you to do. But without wasting time, since you already have this material with you, please open to the material, because I want to switch to the working notes so that quickly we can complete this question and move to the next one. Let me know if you can see the screen for the working notes. Can you? Can you see my screen?
Yes, sir.
All right then, thank you. So this the things we did last time. Okay. Okay. So we have solved for A of the question. This is where we stop. So we continue from here. So we want to solve for the B. For the B parts, examiner wants us to calculate Let me change the. So examiner wants us to calculate covariance between the two securities and correlation coefficients. Whether you are asked or not is something that you must do. I would then say correlation covariance, calculating covariance between securities X and Y. So covariance between X and Y will be calculated as summation of probability of X minus X bar multiplied by Y minus Y bar. Okay, so this is the formula to calculate covariance between securities. So I would then say states. There are three states of nature: state A, B, C. I need to create a column for the probability. Then I will create a column for X minus X bar, column for Y minus Y bar, then column for probability of X minus X bar multiplied by Y minus Y bar. All right. So we have probability, let me see, probability of 0.3, 0.45, and 0.25. Probability of 0.3, 0.45, 0.25. Then X minus X bar, we have calculated it before. So when you come here, you will see X minus X bar. This is it, X minus X value is there. So 4.6, 1.6. Here is 4.6, 1.6. Then for state C, we have minus 8.4, minus 8.4. Then Y minus Y bar. Y minus Y bar is also here. Minus 3.3, minus 3.3, 0.7, then 2.7, 2.7. So we need to multiply the three of them. All right, then, so bring out your calculator. I would then say 0.3 multiplied by 4.6 multiplied by 3.3 minus equal minus 4.554 minus 4.554. Okay, the next one, 0.45 multiplied by 1.6 multiplied by 0.7 equal 0.504, 0.504. The last one, 0.25 multiplied by 8.4 minus multiplied by 2.7 equal minus 5.6 minus 5.67. So we need to add everything together plus 0.504 minus 4.554 equal minus the answer here is minus 9.72. Minus 9.72. This represents the covariance between security X and Y. Summation. That's that. So now that I have the covariance between X and Y, I need to calculate correlation coefficients. So B2 is calculating correlation coefficients. Correlation coefficient, R. R will be calculated as covariance between security X and Y divided by standard deviation of security X multiplied by standard deviation of security Y, which is equal to minus 9.72 divided by, we have calculated standard deviation of security X and Y previously. So let's go, standard deviation of security X is 5.01. 5.01 multiplied by standard deviation of security Y, 2.3. Here is the 2.3. 2.30 equal. So bring out your calculator. I have 5.01 multiplied by 2.3 equal to 11.523. Therefore, 9.72 minus divided by 11.523 equal minus 0.84. Minus 0.84. So that's the correlation coefficient between security X and Y. So this means that the relationship between security X and Y is is highly negatively correlated. I would then say the relationship between securities X and Y is highly negatively correlated. Okay, considering the correlation coefficients of minus 0.84. So if your correlation coefficient calculated is less than 50, is less than 0.5, you can say the relationship between the securities is positively or is lowly positively or negatively correlated. If it is above 50%, you will say that the relationship between the security is highly positively or negatively correlated. If the correlation coefficient is perfect one positive or perfect one negative, then you say the relationship between the two securities is perfectly positively or negatively correlated. So that is the way you are going to interpret your correlation coefficients. So at this point, we are done with B. Let's move to C. Number C, you have to calculate the return of the portfolio and the standard deviation of the portfolio, okay, using tabular method. All right. So if that is the case, I would then say number C, calculating expected return of the portfolio, calculating expected return of the portfolio and standard deviation of the portfolio. In this case, using tabular method, we are using tabular method because in numbers D, examiner was specific that you should use the general formula to calculate expected return as well as the risk of the portfolio. So if you are using tabular method, two things you are going to do. The first thing is for you to represent the two securities in another letter. We have security X and Y because you want to make the return of the two securities, you want to make it 1 for you to be able to get the return of the portfolio and standard deviation of the portfolio. So in this case, the return of the securities is X and Y. I would then say let's X and Y equal to, you can use any letter, you can use A, you can use B, you can use M. Just represent it with any letter. So I will just say let X and Y equal to A. So if X and Y is equal to A, then of course, now you need to determine possible state of nature or possible outcomes. Your possible outcome will depend on the matrix of your probability. If in the question, say for example, security X has probability of 0.3, 0.5, then 0.2, then security Y have probability of 0.5, 0.1, then 0.4. This is 3 by 3 matrix. So 3 times 3 will give us 9 possible outcomes. So when you want to calculate your return and the risk of the portfolio, you are going to have 9 possible outcomes. However, if one of the security is having 3 matrix and the other one is having 2, for example, 0.50. So in this case, this is matrix, this is a 3 by 2 matrix. In this case, 3 times 2 will be 6. So we are going to have 6 possible outcomes. If the two of them have 2 different probabilities, 0.5 plus 0.51 for X, then for Y, 0.5 plus 0.5, that's for 2 by 2. 2 times 2 will be equal to 4. That means you are going to have 4 possible outcomes. However, as far as this question is concerned, it's only one probability that we have for the two securities, 0.3, 0.45, and 0.25. It means that there is a relationship between, it means security X and Y are related, and that is why we calculated that negative correlation coefficient. Remember, I told you last week as well that once the two securities have different probabilities, it means there is no relationship between the two securities. That means your R will be equal to 0. This R, this small letter R, will be equal to 0 once the two securities have different probability. But in this case, we are given the same probability for X and Y. Therefore, I'm going to create a column for the state of nature. Then you are going to have workings for the returns, because you are going to recalculate your returns, which you are going to use. Then we are going to have the return. In this case, we are using A. So we are going to have the return. All right. Then we are going to have the probability. Then you are going to have expected value. After the expected value, you have A minus A bar, A minus A bar, A minus A bar square, then P of A minus A bar square. All right. So let's take it one by one. State A. Now, when you want to calculate your return, remember you want to combine X and Y. That's why you said let X equal to A. So you want to combine the return of security X and Y. So under state A, the return of security X is equal to, let's go and check, under state A, the return of security X is equal to 0.25. Sorry, is equal to 25. All right. Then the weight of security A, according to the question, we are told that 60% will be invested. 60,000 naira will be invested on security X, which is 60%, because 60,000 divided by 100,000 will give us 0.6. Okay. So if that is the case, I will then come here. So you are supposed to multiply the return of one security with the return with the weight of that security. So we are investing 60% on security X. So I would then say 0.60 multiplied by 25 plus, let me reduce the font so that I can accommodate that. 0.60 multiplied by 25 plus, we're investing 40%. If you invest 60% on security Y, on security X, it means that you are going to invest the remaining balance of 40% on security Y. So for security Y, what's the return of security Y under state A? Which is 14. That's the 14 you have there. I would have loved it if somebody should be calling the number for me. Here is 14. Therefore, to get the return, I would then say 0.6 multiplied by 25 equal 15. 0.4 multiplied by 14 equal plus 15 equal 20.6. The return is now 20.6, which is the combined return. I will move to state B. Under state B, we are investing 60%. We are investing 60% on security X. So under state B, return of security X is equal to 22. Then the return of security Y equal to 18. 22, then 18. Plus 0.4 multiplied by 18. So here will be, open a bracket, 0.6 multiplied by 22, close the brackets, plus, open a bracket, 0.4 multiplied by 18, close the brackets, equal 20.4. State C, 0.6 multiplied by the return of security X under state C equal to 12. Then the return of security Y under state C is 20. So 12, 20. 12 plus 0.4 multiplied by 20. So bring out my calculator. Open a bracket, 0.6 multiplied by 12. Close the brackets, plus, open a bracket, 0.4 multiplied by 20. Close the bracket, equal 15.2. Then the probability. Now, the probability you are supposed to put here must be the combined probability. If, for example, in a situation whereby the probability of each of the security X and Y is different, in that case, what is important is that you are going to go and pick the probability of this 25 return. You multiply the probability of this 14. Whatever you have, you come and put it there. Probability of this 22, return of 22, multiplied by probability of the return of 18. You put it there. Do the same thing for C. Probability of 12, then probability of the return of 20. Multiply together, you put it there. But in this case, the two of them have the same probability. Therefore, there will be no need for that. Since they have the same probability of 0.3, 0.45, and then 0.25. So all I need to do now is to get my expected value by multiplying the return. Here is the return of X. In this case, it's no more X because we have said let S and Y equal to A. So this one will then be equal to, this one will be A. So probability of the A. All right, here will be A bar. We're going to calculate the expected value. So in this case, I would then say 15.2 multiplied by 0.25 equal 3.8. Here is 3.8. I will do the same thing. 20.4 multiplied by 0.45 equal 9.18. Finally, I will do for the state A, which is 20.6 multiplied by 0.3 equals 6.18. So I need to multiply, I need to add together everything plus 9.18 plus 3.8 equal 19.16. 19.16. This represents the return of the portfolio, that is A bar. That's the return of the portfolio. Okay, the return of the portfolio. Now that I have the A bar, I would then say A minus A bar. A is 20.6. A bar is 19.16. Therefore, 20.6 minus 19.16 equal to 1.44. Here is 1.44. 1.44 square. 1.44 square equal to 2.0736. Here will be 2.0736. So 2.0736 multiplied by probability. Probability of 0.3 multiplied by 0.3 equal, that's 0.6228. Here is 0.62208. Okay. I'll go ahead and do for the next one. 20.4 minus 19.16 equal 1.24. Here is 1.24. 1.24 squared equal to 1.5376. 1.5376. 1.5376 multiplied by probability of 0.45 equal 0.69192. 69192. Then the third one is 15.2 minus 19.16 equal minus 3.96. Minus 3.96 squared equal 15. Here is 15.6816. Then multiply by probability of 0.25 equal 3.9204. 3.9204. So we need to add everything together. You add all of this together to get the variance. So let us add them together. Plus 0.69, 192 plus 0.62208 equal, that's 5.2344. Here is 5.2344. Let me confirm. Yes, that's it. So finally, to now get the risk of the portfolio, I would then say the risk of the portfolio measured by standard deviation is the square root of the variance. So square root of the variance, which is summation of probability of A minus A bar all square equal to square root of 5.2344. So square roots. That's 2.29. Here I have 2.29. So the risk of the portfolio is 2.29. All right. The risk of the portfolio is 2.29. You rule your table. Rule your table. All right. Okay, then. So let's go to the next one, which is number D. The number D, examiner wants us to calculate the same thing in return of the portfolio, but in this case, you are supposed to use general formulae. Examiner wants us to use formula to get the same thing. Therefore, I would then say number D, calculating expected return. Calculating the return of the portfolio and then the risk of the portfolio using general formulae. Using formula. So in this case, using formula to calculate the return of the portfolio, number D1, return of the portfolio, RP. So RP will be calculated as, by now I expected that you might have memorized, you would have memorized the formula that are all the formulas I gave to you last time. So to calculate the return of the portfolio, you are going to multiply the proportion invested on security X. You multiply with the return, the expected return on security X, plus the proportion invested on security Y, multiplied by the expected return on security Y. So the return of the portfolio will then be equal to, we're investing 60% on security X multiplied by expected return on security X. Expected return on security X, we calculated the expected return on security X, we calculated 20.4. Okay, we calculated 20.4 for X. Then we calculated 17.3 for Y. 20.4, 17.3. Here is 20.4 plus, since we are investing 60% on Y on X, then we are investing 40% on Y. So multiply by 17.3. Therefore, I would then say 0.6 multiplied by 20.4 equal 12.24 plus, we're investing 40%, okay? 0.4 multiplied by 17.3 equal 6.92. When you add the two together, we should have the same thing as 19.16. Let me confirm, plus 12.24. That's 19.16, which is consistent with what we got here. See, it's the same thing we got here, 19.16. That is what the examiner wants you to do. Then the second part, high, calculating the risk of the portfolio. Portfolio risk as measured by standard deviation. So the risk of the portfolio will be calculated using formula method. It will be calculated as the square root of the proportion invested on security X, square it, the variance of security X plus proportion invested on security Y, square it, then variance of security Y plus 2, because this is two asset portfolio, X and Y, then multiply by 2 multiplied by amount invested on security X, multiplied by standard deviation of security X, multiplied by proportion invested on Y, standard deviation on Y, then all multiplied by correlation coefficient between X and Y. So that's the formula. Then our risk of the portfolio will then be equal to, we're investing 60% on security X, square it, multiply by the variance of security X. Let's go and check the variance of security X that we calculated previously. Security X variance. We got 25.14. That's the variance of security X, 20.14. Multiply by 25.14. Okay, that's the variance plus 40% multiplied by the variance of security Y, which is 5.31, plus 2 multiplied by standard deviation of X, which is I think 5.01. Let me confirm. Standard deviation of security X. Yes, that's 5.01. Standard deviation of security Y is 2.3. So multiply by 0.60 multiplied by 5.01 multiplied by 0.4 multiplied by 2.3, 2.3, or multiplied by correlation coefficient of minus 0.84. 0.84. Let me write this so that's 0 minus 0.84. Okay, manage it like that. All right then. So, of course, we have to square it. Square root. So the risk of the portfolio will then be equal to, bring out your calculator, 0.6 square equal 0.6 square. Zero 0.6 square, then multiply by 25.14 equal 9.054. Here is 9.0504. Then the next one is 0.4 square multiplied by 5.31 equal, here is 0.8496 plus 0.8496. Okay, then plus, now, in the D part of this question, examiner wants you to change your correlation coefficient to +1, plus 0.50, then minus 0.2, minus 1. So in this case, what we are going to do, what you are supposed to do is that so that only your R will be changing, only this R will be changing, which is 0.84. So in this case, you need to multiply by the rest, excluding the 0.84. So I would then say 2, I will say 0.6 multiplied by 5.01 equal, let me use I will say 2, open a bracket, 0.6 multiplied by 5.01, close the brackets, multiply by, open a bracket, 0.4 multiplied by 2.3, close the brackets, equal, here is 5 points, here I have 5.53, 104, then multiply by minus 0.84. It's clearer this way. Therefore, of course, do your square root. Then the return of the portfolio will then be equal to multiply by 0.84 minus, this one will give me minus 4.66460 736. Then 9.0504 plus 0.8496 equal 9.9. Here is 9.9. Therefore, 9.9 minus 4.6460736 equal. So square root, the risk of the portfolio will then be square root of 5.25 25392 39264 square roots. That's 2.29. The answer is equal to, the risk of the portfolio is equal to 2.29. This must be the same thing as we got previously using the tabular method. Yeah, so it must be the same thing, 2.29. 2.29, that's it. This is what the examiner wants to achieve. That's why you are asked to use general formulae at the time on the tabular method. So that's that. Then finally, examiner wants us, when you go to the question in the E parts, examiner asks you, would your answer to D above be different if the correlation coefficient had been +1, plus 0.50, or -1? I will just do 2 for you. Then you do the rest on your own. So number E. Roman figure 1. When R is equal to +1, then the risk of the portfolio will then be equal to, I will then pick my 9.9. 9.9 will remain constant. That's what I told you, that only the other part where you have correlation coefficient that will change. So instead of using minus 0.84, so it is that minus 0.84 that will be changing. Now the examiner has told us that if R is equal to +1, then in this case, I would then say plus, open a bracket, 5.53104 multiplied by 1, because my R is now 1. All right. So if that is the case, then the risk of the portfolio will then be equal to square root of 9.9 plus, let me use calculator to save time. Let me just remove this 9.9. So this will now be 9.9 plus 5.53104 equal, that's 15. Square root of 15.43014. Final answer will then be square root of that, which is 3.93. 3.93. That's the risk of the portfolio if R is perfect 1. Then high, when R equal to plus 0.5. So in this case, the risk of the portfolio will then be equal to 9.9 plus again 5.53104 multiplied by 0.5. It is only the R that will change. So in this case, the risk of the portfolio will then be equal to 9.9 plus 5.53104 multiplied by 0.5 equal, so plus 2.76552. Find the square root. So the risk of the portfolio will then be equal to square root of plus 9.9 equal 12,66552. 12,66552, which is equal to square root 3.56. 3.56. Let me quickly do for the rest. Number 3, when R equal to 0. When R is equal to 0, then the risk of the portfolio will then be equal to 9.9 plus 5.53104 53104 multiplied by 0. Okay, multiplied by 0. So if the other part is multiplied by 0, that means the answer will be equal to 0. Therefore, DP will then be equal to square root of 9.9, which is equal to 9.9 square root. That's 3.15. Here is 3.15. Finally, the fourth one, when R equal to -1. When R is equal to -1, then the risk of the portfolio will be equal to 9.9 plus 5.53104 multiplied by -1 square root The risk of the portfolio would then be equal to 9.9 minus 5.53104. Okay, so the risk will be equal to square root of 9.9 minus 5.53104 equal 436 4.36896 equal square root. That's 2.09. 2.09 is the risk of the portfolio. So examiner is now asking you, what conclusion do you draw? What conclusion do you draw? You notice that when the correlation coefficient was perfect positive 1, perfect positive 1, the risk of the portfolio was 3.93. When the correlation coefficient is perfect negative 1, the risk of the portfolio has reduced to 2.09. Therefore, examiner is now asking you, what conclusion do you draw? I would then say the higher conclusion the higher the correlation coefficients, the higher the correlation coefficients, the higher the risk of the portfolio, and vice versa. That's it. That's the end of the question. Please let me know if you have any question before we move to the next one. Quickly, talk to me. Let me know if you have any question in what we have done so far. Even though you did not participate, you did not give me number, no worries. I keep on complaining every now and then. I think I will stop saying that. Just move on to do whatever I need to do. So any question for me so far? Okay. So in the absence of no further question, so we can close this topic and move to the next one. Now, you have an assignment for me in place. So you go to the material I share with you on the portfolio theory. Go and solve illustration number 2. Go and solve illustration number 2 and submit not later than, today is Wednesday, not later than Sunday. Okay, not later than Sunday. You have to submit this coming Sunday. All right, and today is the 3rd of April. Okay, that means on the 7th of April you have to submit that. Okay, then let me stop sharing. Prosper, you are welcome. Zainab.
Thank you, sir.
All of you came late. No worries. Zainab, are you there? Okay, let me share my screen with you. Yes, I believe you have seen I believe you have access to the material because it was shared with you earlier today. Now, we want to talk about capital asset pricing model. The capital asset pricing model is just a continuation of a portfolio theory. And then there are basically two focuses of capital asset pricing model. One is to establish the expected return on security, as well as the systematic risk of the security. Now, when you talk about capital asset pricing model, it's a model that establishes the relationship between the expected return of an asset and the systematic risk as measured by beta. Generally, capping is used for pricing risky assets. When you say risky asset represents stocks or shares, okay? So capital asset pricing model is used to pricing risky assets. It is also used to determine expected return on security. Then thirdly, it's used for calculating cost of capital. Okay, those are the three uses of capital asset pricing model. All right. Therefore, how do you then calculate capital asset pricing model? You already know the formula for calculating capital asset pricing model because it's something we have been doing in the past. We have done it under cost of capital, project-specific cost of capital. Severally, we have done calculation on this. However, to calculate your capital asset pricing model, which is also cost of equity, then you are going to, your RS is the expected return of the assets. Then the RF is the risk-free rate of return. The B is the beta, which measures risk of the assets. Then RM is the market return. So the difference between RM and the RF represent the risk premium. Okay. So if that is the case, like I said, you already know how to calculate capping using this formula. So that's not our focus. Now, let's talk about assumptions of capital asset pricing model, because this is an examinable area. It's an examinable area. Just take your time to review it. One of them is that investors are risk averse, utility maximizing, and then rational individuals. When you say risk averse investors are those investors that do not like risk. All right. And the fact that, despite the fact that they do not like risk, they want to maximize their expected return. Okay. Then the next one says that markets are frictionless, including no transaction costs, and there is no taxation. It's not possible. When you make profits, you are expected to pay tax on that profits. And they say, yeah, there will be no transaction cost. When you invest in security, in equity, for example, in equity, there's no how you are not going to incur transaction. Irrespective whether you invest in equity or bonds, you are going to incur transaction costs. So tax will also impact that transaction. So the assumption that markets are frictionless, no transaction cost, no taxation is not realistic. It is only in theory. Then investor, the third one says that investor plan for the same single holding period. Okay. Then the fourth one says that investors have homogeneous expectation. It is not possible. This is not possible. All investors cannot have the same expectation because we have different aspiration, different exposure, different experience, and our expectation will surely be different because our level of risk is also different. All right. Somebody that can take a higher risk is different from someone that that cannot take a higher risk. So it is expected that the higher your risk, the higher will be your return. So if you are now saying that investors have homogeneous expectation, the outcome will be the same thing. It is not possible in reality. Then the fifth one says that all investments are infinitely divisible. Not all investment can be divisible. When you say divisible, simply means that part of the investment can be invested. Okay, part of the investment can be, can be invested. Say, for example, you have a, you can take for example, you can take 30%. You can invest 30% of the total original amount. You can invest 70, you can invest 70%, you can invest 99%, whatever. So what this is saying is that for the foreseeable future, that investment is divisible. That a fractional part of the investment can be undertaken. That is not compulsory that you must do 100% of the investment. Again, it is not all investment that is divisible. Okay, that's the bottom line. Then the last one says the investors are price taker. Yes, it is possible. If you say investors are price taker, it means that whatever the markets go to give to the investor is what the investor will take. All right, because generally the price are determined by the forces of demand and supply. So it is what the market gives to the investor that investor will take. All right. However, like I said, you already know how to estimate capital pricing model. So we don't need to waste our time on that. But take your time to review the material to learn more, have more idea of what CAPM is all about. All right. Then let's go to estimating beta value. Estimating beta value. Now, like I told you, beta value is used for measuring risk. It's a measurement of risk. And it measures how sensitive an asset beta. It measures how sensitive an asset's return is to the market as a whole. All right. So the bottom line is that when you talk about beta is used to measure the risk of the assets of the security. Okay, it's used to measure the risk of the asset or of the security. It measures how sensitive the assets return is to that of the market as a whole. So there are three types of beta. We have positive beta, negative beta, and also zero beta. When you say positive beta, a positive beta shows that the return of the asset follow the direction of the market. Okay, the return of the asset, when you say positive beta, indicates that or shows that the return of the asset follow the market's direction. Okay. Then a negative beta indicates that the return of the assets follow the opposite direction of that of the market. All right. So that is a negative beta. Then the zero beta indicates that there is no relationship. Okay, there's no relationship between the asset return with that of the market. So a zero beta indicates that the asset return has no correlation with that of the market. So that means that a zero beta indicates that the asset return is risk-free. There's no risk attached to it. That's the implication. All right then. So yes, how do you then estimate beta? How do you estimate beta? Let me use this one. This will also save our time. Now, when you want to calculate, the only challenge that is associated with capping is the fact that examiner can test you in any form, in any ways. But the bottom line is that the challenge associated with capping is because of this beta value. Okay, the challenge is how to estimate the beta value, because there are 5 different ways in which you can calculate beta value. And on that day of your exam, if your examiner is going to test capital pricing model, so the challenge will be how you are going to estimate the beta. And that is essence of this, what we want to do now. I will give you the entire 5 formulas. 4 of them is in this material. Then the last one I will add to it. And I will also show you the order of frequency, how I can usually test it, the one that is most prominent. I will show you. Now, when you want to calculate beta value, examiner will just print a scenario for you. They will now ask you to calculate the overall the risk of the portfolio, or to calculate beta factor. All right. So depending on the nature of the question, or depending on the information given to you in the question. Now, if in the question where you are given correlation coefficients, and standard deviation are given, then this is the formula you are expected to use. In that case, your beta will be correlation coefficients multiplied by standard deviation of the security divided by standard deviation of the market. So I repeat, where correlation coefficients and standard deviation of securities are given, then your beta value will be calculated as correlation coefficient multiplied by standard deviation of security divided by standard deviation of the market. This is the most prominent or the most frequent formula. 2, the second most frequent formula is a situation whereby if you are given covariance, let me write that. If you are given covariance and variance of securities, then in this case, this is the formula you are supposed to use to calculate your beta value. This is the second most frequent formula that I can usually test. In this case, the covariance between security of the markets divided by the variance of the markets. Okay? So I repeat. The covariance of security of the markets divided by variance of the markets. That is the second most frequent formula. The third one is not in this section of the material, but I will give it to you. If in the question, the third most frequent is a situation, if in the question you are given, okay, if you are given, let me just say, where number of shares, market value per share, and beta factor of the securities are given. Then in this case, you are supposed to use weighted average. So you use weighted average. Use weighted average. Now, the weighted average will not be given to you in the question. You are the one that will determine it. So let me just give you the format. So you are going to create a column. Using weighted average, you are going to create a column for companies. You create a column for number of shares, market price per shares. Then you have total market value. You create a column for the beta factor. Then you create a column for the weights. Say this is A, this is B. C will be equal to A times B. This is D. Then this is E. Okay. Oh, my pen is not connecting again. All right, then. Let me just save and reshare. Oh, okay, it's back. All right, E will then be equal to B times C. Sorry, C times D. C times D. Therefore, I will then create I will create, let's say we have security A, B, and C in the portfolio. Whatever you have here as number of shares, you multiply the market price per share to get the total market value. Then the beta factor of individual security will be given to you. Whatever it is, put it there. Then the market value multiplied by the beta factor of individual will give you the weights. You total the weights. So you have the total weights. Then you also calculate total market value. So the total market, to now get the beta value, the beta value will then be equal to total weights divided by total market value. So that's that. Like I said, this is the third most frequent formula that you are going to use for calculating your beta value. Then, of course, the fourth one is where you are given regression analysis information. Where you are given regression analysis, then your beta value will be equal to n summation xy minus summation x summation y over n summation s squared minus summation x all squared. So this is the formula you are supposed to use if you are given regression analysis information. N will be the number of period. X will be the return on portfolio, on market portfolio, then Y is the return on the security. All right. The last one is where you are given excess return on security and the excess return on the market. Like I said, the fourth one, which is this one, is used where regression analysis information, where regression analysis information is given. So that's for that. Then the last one, of course, this is the fourth most frequent, and the last one is this one. This is the least frequent formula for calculating beta. In this case, examiner will give you excess return on security. We're also going to be given excess return on the market. All right. So the difference between expected return and the risk-free rate of return represent the excess return on security. So the difference between market return and the risk-free rate of return represent your excess return on the market, which is your risk premium. So these are the formulas that you can use to estimate your beta value. But the bottom line is that you have to memorize the 5 because you don't know where examiner will come out to you. But like I said, I've also made life easy for you by telling you how frequent each of the formulas are. So but I can assure you, this number one formula, the one that is the number one, the priority, the most frequent. When you look at, I can count about 7 to 8 times in the last 12 diets that ICANN has tested the capital reserve pricing model, because it's one of the most frequent topic that is being tested by ICANN. So, which means that you cannot go to the exam hall without the knowledge of a capital asset pricing model. So this is number one. This is one part of capping. Let's go to the other parts before we solve any illustration. The other part of capping is to determine alpha. Examiner can ask you to calculate alpha. Therefore, how do you estimate alpha? First thing first, you don't have it in this material. Let me just show you. Calculating alpha. Okay, calculating alpha. What do you mean by alpha? Alpha represents, this represents the difference between expected return and the required return and the required return on security. In this case, the required return simply means the capital asset pricing model, you're capping. Alpha can be estimated as follows. Now, if you have to calculate alpha, the first thing first you are going to do, let me even give the format first. I will then explain it. All right. So to calculate alpha, you are going to create a column for companies in the portfolio. Say you have company A, B, then C. You are going to create a column for expected return. This expected return will surely be given to you on the day of your exam. In most cases, the expected return will be given. Then you are going to create a column for required return. This required return, like I said, is simply the capping. Then finally, you are going to create a column for alpha. Then, of course, you may want to include comments because at the end of your calculation, you need to advise on the outcome of your analysis. Okay. Say we have X as return. Then we then proceed to calculate the required return. The difference between expected return and the required return will give us alpha. Then you put in your comments. This is how to calculate alpha. Then you need to interpret your alpha. I don't have space. Let me use this, let me manage it. So you need to interpretation. You need to interpret whatever you have calculated as alpha. So number one, if expected return is greater than the required return, then the security is undervalued. The security is undervalued. If the security is undervalued, what are you supposed to do? More of the security should be bought. More of the security. Let me see if I can get a bigger space. Okay, I just manage that. So more of the security, more of it should be bought. This is because the security is being traded below the intrinsic value. So once the security is undervalued, you need to buy more so that when the price increases in the future, you just dispose it to make more money. All right. Then number two, if expected return is less than the required return, it means that the security is overvalued. The security is overvalued. So if the security is overvalued, what are you supposed to do? You dispose of the security should be sold. Once the alpha is negative, once your alpha is negative, that means it is overvalued. If it is overvalued, you dispose the security. If your alpha is positive, it means the security is undervalued. If the security is undervalued, more of it should be bought. Then the last one, number three, let me use it. Number three, if expected return is equal to required return, it means that the security is properly priced or properly valued. The security is properly priced or valued. It's properly valued. So if the security is properly valued, then what are you supposed to do? The security should be kept. The security should be kept, or the company should hold on to the securities. So these are the things you need to do in calculating your alpha. It is not sufficient for you to just calculate alpha without interpret, whether examiner asks you or not, you need to interpret your results. So these are the things we need to do. We are done with all the explanations as far as capital pricing model is concerned. The next thing we need to do now is to have illustration. Please let me know if you have any question for me before I switch to the working notes. Okay, so let's have illustration to that effect. Because of time, we are going to solve one illustration. Then we move to, okay, let's solve this question just to bring your mind back to what we did previously. Let's solve illustration number one. Who will read? Somebody should read for us, please. Illustration number one, Jalingo PLC. I need somebody to read for us.
Illustration 1.
Thank you, Prosper.
Jalingo PLC is all equity company with a beta of 0.8. The risk-free rate is 10% and the expected return on the market is 18%. Jalingo PLC increases its gearing to be a debt-to-equity ratio of 0.5. Income tax rate is 35% required. 1. Compute Jalingo PLC's cost of equity when ungeared. 2. Compute Jalingo PLC equity beta when geared up. 3. Compute Jalingo PLC cost of equity when geared. And 4. Check the answer to 1 and 3 using the M&M formula.
All right. Thank you very much, Prosper.
Okay.
If not because of the constraint that we have, ordinarily I would have thrown this question to all of you to solve. But because of the fact that we are behind our schedule, and that's why I wouldn't want to waste time. Now, in this requirement 1, examiner is asking you to calculate Jalingo PLC's cost of equity when ungeared. You want to calculate cost of equity ungeared. Then what are you supposed to do? When you're asked to calculate cost of equity ungeared, you need to ask yourself what kind of cost of equity. Is it cost of equity using dividend valuation model? Is it cost of equity using a capital asset pricing model, or cost of equity using Miller and Modigliani formula? You know, all of this I've explained to you previously when we had cost of capital. So because examiner say calculate cost of equity when ungeared, and examiner has given to you information of capping, then you need nobody to tell you that you are supposed to calculate cost of equity using capping information. There's no need for me to switch. I can manage this space. Therefore, to answer the number 1 requirement, you want to calculate cost of equity ungeared. And you know, in our previous classes, we said cost of equity ungeared equal to risk-free rate of return, because we are using capping. Capping information is given. What do you mean by capping information is given? Examiner has given us risk-free rate of return to be 10%. Examiner also give us market return to be 18%. You're also given the beta. We also given the beta of the security to be 0.8. What else are you looking for? I would then say plus the beta into market return minus risk-free rate of return. So in this case, my risk-free rate of return is 10%. The beta is 0.8. Market return is 18% minus 10. So what do you have here? That should give me 16.4%. That answers number 1. Examiner wants us to calculate cost of equity when ungeared. Number 2, you are required to compute Jalingo PLC's equity beta when ungeared. Number 2, you want to calculate equity beta when ungeared. And you know that beta equity of a gear is calculated as beta assets multiplied by 1, because in this question we do not have debt beta. So if you don't have debt beta, then beta equity of a gear will be calculated as beta assets plus 1 minus tax multiplied by debt equity proportion. Okay, multiplied by debt equity proportion. So if that is the case, I would then say the beta equity of a gear equal to, what is my beta assets? Examiner told you that be a debt to equity ratio of 0.5. How did I know that 0.8 is beta assets? Examiner told us in the question that Jalingo PLC is all equity company. It's an all equity company. There's no debt in its capital structure. So if that is the case, then that would be 0.8. Then multiply by 1 plus, what is tax rate? Tax rate is 35%. So we are supposed to account for 65%, 0.65. Multiplied by debt equity proportion is 0.5. Therefore, beta equity of a gear will then be equal to, I'll bring out my calculator to say 0.8 multiplied by, bring out your calculator to 0.5 multiplied by 0.65 equal plus 1 equal So multiply by 1.325. Finally, beta equity of a gear will then be equal to multiply by 0.8. 1.06. 1.06 is the beta equity of a gear. Number 3, you are required to compute Jalingo's PLC cost of equity when geared. Calculate cost of equity when geared. This simply means that you need to calculate cost of equity of a gear. And you know, cost of equity of a gear will be calculated as, in this case, if you are not using Miller and Modigliani formula, then it means that you are supposed to, examiner has to calculate cost of equity when geared. That is, you need to use a gear beta to calculate your capping. You use a gear beta to calculate your cost of equity, capping. Therefore, I would then say risk-free rate of return plus the gear beta, market return minus risk-free rate of return. So cost of equity of a gear equal to the risk-free rate is 10% plus beta of gear beta is 1.06. That's what we calculated is 2. Then multiply by market return and risk-free rate of return. The difference is that one is 18. Then the other one is 10. The difference is 8. Therefore, finally, cost of equity of a gear is equal to, I'll bring up my calculator, 8 multiplied by 1.06 equal plus 10 equal 18.48. Here, 18.48%. You can see the way it's flowing. You have to know what to do at the right time. The last one, number 4, you have to check the answers to 1 and 3 above using M&M formula. Examiner wants you to check your answer to 1 and 3 above, meaning that you need to calculate. You need to calculate cost of equity of a gear using Miller and Modigliani formula. Using Miller and Modigliani formula. So if that is the case, let me see if I can manage this small space. Number 4 here. So using cost of equity of a gear, using that space cannot occupy it. Okay, let me use it, please. I hope when you are copying your notes, you'll be able to join them together. So number 4 requirements. Cost of equity of a gear using Miller and Modigliani. Examiner wants you to use Miller and Modigliani to calculate your cost of equity of a gear. So, you know, using Miller and Modigliani, cost of equity of a gear is calculated as cost of equity on gear plus, open a bracket, cost of equity on gear minus cost of debt, all of this multiply by debt value into 1 minus tax divided by equity value. We use this formula when we had the asset price, when we had the adjusted present value. So cost of equity of a gear, so here is cost of equity of a gear equal to cost of equity on gear, we calculated 16.4. Let me confirm. Cost of equity of gear, yes, 16.4 is what we calculated. All right. Plus cost of equity on gear, 16.4 minus the cost of debt. Cost of debt represent the KD, represent the cost of borrowing, the interest rate on the debt. In this question, examiner did not give us interest rates on anything. So if that is the case, since interest rate is not given to you, KD is not given to you, then whenever KD is not given, whenever cost of borrowing is not given, you are going to assume risk-free rate of return. It is assumed that the debt is risk-free, okay? The debt is risk-free. So in this case, I will assume 10%. So I would then say 10% as the risk-free rate of return. Then multiply by D over E is 0.5. Examiner gives to the debt equity proportion is 0.5. Then multiply by 0.65. Let me write that. Zero 0.5, or let me just say 0.65 multiplied by 0.5. Okay, so so 16.4 plus the difference between 16.4 minus 10 will give us 6.4 multiplied by 0.65. 0.65 multiplied by 0.5 equal 0.325. 0.325. Therefore, cost of equity of a gear will then be equal to multiply by 16.4 multiply by 6.4 equal 2.08. Here is 16.4 plus 2.08. So cost of equity of a gear will then be equal to, I need to add plus 16.4. That's 18.48. Here is 18.48%. So what the examiner wants to achieve here is that you can either use CAPM or you use Miller and Modigliani formula to calculate your cost of equity of a gear, and you get the same thing. So when you look at, when we calculated cost of equity of a gear, we had 18.46, 18.48. When you use Miller and Modigliani, we got the same answer, 18.48. That is what examiner wants to achieve. All right. I believe that is clear. Please, when you are forming your notes, you have to know it's scattered here and there. So let's calculate. Let's have another illustration. If I can have 2 more illustrations, that will be fine for me. Okay. Let me go to where you have alpha. Let's solve this illustration number 9. Let's solve illustration number 9. Yes, who will read for us again? Any volunteer, please?
Illustration 9.
Thank you.
Balloon PLC has been enjoying a substantial net cash inflow. The funds have been invested in a small portfolio of short-term equity investments until they are needed to meet tax, dividend payments, and to finance further capital expenditure in several months' time. Details of the portfolio, which consists of shares in 4 Nigeria-listed companies, are as follows. The companies: Dashing PLC, Elegant PLC, Fantastic PLC, and Gaudi PLC. So am I supposed to name the holdings? And
No. That's
okay. The yield on treasury bill is 11% a year, and the market return is 19% a year. Required: based on the data given, calculate the risk, that is beta, of Balloon's short-term investment portfolio relative to the market. B, recommend giving your reasons whether the composition of the company's short-term investment portfolio should be changed. Relevant calculations must be shown. C, discuss the factors that the financial manager should consider when investing in a marketable securities.
Thank you very much, Prosper. Because of space, let me stop sharing this and move to the working notes, please. Okay, let me know if you can see my working notes.
Yes, sir.
All right then. So the name of this company is Balloon PLC. You go back to the question, what was the first requirements? You are told that based on the data given, calculate the risk, that is beta, of Balloon's short-term investment portfolio relative to the market. So examiner wants you to calculate the risk of the portfolio using beta, using capital pricing model. You can see when you say risk of the portfolio, the risk is usually risk of the portfolio will be measured by the beta, unlike under portfolio theory, whereby you measure the risks using standard deviation. But in this one, under capping, the risk will be measured by beta value. So when you go to the question, you will see that already examiner has already given to us the beta coefficient for each of the securities, for each of the company, 1.6 for Dashing PLC, 1.28 for Elegant PLC, 0.9 for Fantastic PLC, then 1.5 for Godi PLC. So the beta factor of individual security in the portfolio has already been given to us. So examiner is now asking us to calculate overall beta, that is the beta of the portfolio. So if that is the case, I need to ask myself, I want to calculate beta value. How am I going to calculate it? I gave you earlier today, I gave you about 5 different formulas that you can use to calculate beta value. One of those 5 formulas is what you are going to use to calculate the overall beta. You can see in this question, number of shares is given to you. You have number of shares, you have market price per share, you also have the beta of individual security. It means that you are supposed to use the weighted average to calculate your beta value. So without wasting more time, I would then say number A, calculating beta value, calculating overall beta value. That is the beta of the portfolio. So, like I said, number of shares are given, market price per share is there. We're also given the beta factor of individual securities. So you are supposed to use weighted average. Using weighted average, I will create a column for company in the portfolio. I will create a column for number of shares. I will create a column for, let me go back to the, am I given market price or market value? So examiner says market price. So market price per share, then I will create a column for total market value, create a column for beta factor of individual, then I will create a column for the weights. This is A, this is B, C equal to A times B, this is D, this is E, E equal to C times D. So we have Dashing, Elegant, Fantastic, and then Godi. Dev G, we have Dev G. Okay, so what's number of shares? What's number of shares in D? So 60,000 shares, and the price is 4.29. 60,000. Here is 60,000. 4.29. Next one is 80,000 with the price of 2.92. 80,000. 2.92. 100,000, 2.17. 100,000 shares, 2.17. The last one is 125,000 shares, 3.14. 125,000, 2.14. Sorry, 3.14. So before we multiply, I need to get the beta factor of individual security. The beta factor of D is 1.16. 1.16, 1.28, then 0.9, 1.5, 0.9, 1.5, 1.5. So I will get my total market value. I will also get the total weights. So let's calculate total market value in this case. I would then say 60,000 shares multiplied by 4.29 equal 257,400. Here is 257,400. For me to get the weights, I need to multiply straight. Multiply with 1.16 equal 298,584. 298,584. Move to the next one. 80,000 multiplied by 2.92 equal 233,600. 233,600. Then multiply by 1.28 equal 299,008. The next one, 100,000 multiplied by 2.17, 217,000 multiplied by 0.9. Mistake. 217,000 multiplied by 0.9 equal 195,300. And finally, 125,000 multiplied by 3.14 equal 292,500. 392,500. They multiply by 1.5 equal 588,750. 588,750. So we need to add them together. Plus 195,300 plus 299,008 plus 298,584 equal 1381,642. That's the total weight. I need to add up the market value. Market value is 257,400 plus 233,600 plus 217,000 plus 392,500 equal 1,100,500. 1,100,500. Therefore, the overall beta will then be equal to total weights divided by total market value, which is equal to 1,381,642 divided by 1,100,500. 1.1381,642 divided by 1,100,500 equal 1.26. 1.26. I need to interpret this. Remember, the risk, the beta of the markets is always 1. The beta of the market is always 1. So if the beta of the security is less than 1, it means the asset is less risky than the market. I repeat, the beta of the market is always 1. So if the beta of the security is less than 1, it means the asset is less risky relative to the market. If the beta is higher than 1, it means the asset is more risky or is riskier than that of the market. In this case, the beta of Balloon PLC's investment portfolio is greater than 1, which means that it is higher than that of the market. So I need to interpret that my results, okay? So examiner is asking, based on the data given, calculate the risk of Balloon short-term investment portfolio relative to the market. Examiner wants you to compare with the market. So I would then say the risk of the investments portfolio is higher than that of the market. Since the beta value of 1.26 is greater than 1. That's that. Then, number B, recommend, given your reasons, whether the composition of the company's short-term investment portfolio should be changed. Relevant calculation must be shown. In this number B part, examiner did not ask you, how will you know? In this number B, you are supposed to use alpha value. You are supposed to calculate alpha. How will you know you are supposed to calculate alpha? Alpha will be calculated if in the question you are given expected return. Examiner has even made life easy for you by telling you that you should confirm or you should recommend, giving your reasons, whether the composition of the company's short-term investment portfolio should be changed. The composition should be changed. In this case, what are you supposed to do? You are supposed to calculate alpha. How will you know you are going to calculate alpha? In the question, examiner has given to you expected return. You have been given the expected return. So in this case, whenever you are given expected return, you can see expected return in a question, then you are supposed to calculate alpha. You need nobody to tell you are supposed to calculate alpha. But in this question, the expected return is not directly given, but there is an information that will enable you to calculate the expected return. Examiner has given to you yield. Yield is the same thing as return. You are given yield, dividend yield. You are also given yield on the capital gain. So there are two different classes of yield in this question. Therefore, to get your expected return, you need to add the two yields together to get your expected return. Then you now proceed to calculating the capital asset pricing model. You go and calculate your capping required return. Then at the end of the day, you find your alpha. Once you get your alpha, then you interpret your results. That is what examiner wants you to do. So quickly, the first thing first, we need to calculate the expected return because it's not directly given to us. So I would then say calculating expected return. ER. So to get the expected return, like I said, examiner has given us dividend companies. I have companies D, E, F, and G. So I have dividend yield. I also have capital gain yield. Then I would have the expected return. So for the dividend yield, we are given 6.10, 13.4. 6.10, 13.4, 3.4, 20.6, 3.4, 20.6, 5.7, 11.8, 5.7, 11.8, 3.3, 11.7, 19.7, 3.3, 19.7, 3.3, 19.7. So add the two together. So I would then have 6.1 plus 13.4, that's 19.5%. Percentage.
Excuse me, sir.
Yes,
Sir, please, this third column is what?
5.70.
No, sir. The third column, like you have companies, dividend yield,
Capital
and
gain yield.
okay, sir. Thank you,
Capital
sir.
gains yield. You're welcome. So 3.4 plus 20.6 equal 24%, and 5.7 plus 11.8 equal 17.5%, 3.3 plus, 3.3 plus 19.7, 23%. So now that we have the expected return, I need to go ahead and calculate my required return. So I would then say required return, calculating required return, which is capping. So required return, risk-free rate of return plus the beta, market return minus risk-free rate of return. For dashing for D, go back to the question. What's the risk-free rate of return? We are given the yield on treasury bill is 11%. So your risk-free rate of return is 11% because the risk-free rate of return is the rate arising from government security. Treasury bill is a government security, so that's 11%. Market return is also 19%. Here is 11 plus, what is beta of security D? Beta of D is equal to 1.16. Here is 1.16. Expected return is 19, yeah. Here is 19 minus 11 equal E, F, G. 11, 11, 11 plus, what is beta of E? Beta of E is 1.28. 1.28. The difference between 19 and 11 is 8. 0.9 multiplied by 8 plus 1.5. 1.50 multiplied by 8. So what do you have there? So I would then say 8 multiplied by 1.16 equal plus 11 equal 20.28. Here is 20.28%. The next one, 8 multiplied by 1.28 equal plus 11 equal 21.24. The third one, 8 multiplied by 0.9 equal plus 11, 18.2%. Then the expected return, the required return of a G, 8 multiplied by 1.5 equal plus 11, 23%. So now that I've calculated my required return and I also have the expected return, I can then proceed to calculate my alpha. I will then say calculating alpha. So to get the alpha, I'll create a column for companies in the portfolio, create a column for expected return, required return, alpha, then I will have comments. So I have security, this is A, this is B, then A minus B. C equal to A minus B. Then security D, E, F, then G. Expected return of D is 19.5%. 19.5. The next one is 24. Then 17.5, 23. 17.5, then 23. Then, of course, required return we computed here is 20.28. We also have, now another thing we can do is to restrict our numbers to, okay, let's just leave it as it is, 2 decimal places. So 20.28, then 21.24%, 18.20, then 23%. So let's get the alpha. Bring out your calculator. 19.5 minus 20.28 equal minus 0.78. So the next one is 24 minus 21.24 equal 2.76. Then 17.5 minus 18.2 equal minus 0.7. Finally, 23 minus 23 will give us 0. And I told you earlier today, if your alpha is positive, it means the security is undervalued. Here is undervalued. If your alpha is negative, it is overvalued. Overvalued. Then if your alpha is 0, if expected return is equal to required return, then the security is properly valued. That's that. So this is one bit we need to advise. I would then say advice or recommendation. recommendation. Examiner wants you to recommend. Number one, my recommendation should be that for Dashing PLC and what is F? What's full name of F? F is fantastic. Okay, Dashing and fantastic. I would then say the shares in Dashing PLC and fantastic PLC are overvalued. Therefore, the securities should be sold. You will see that Dashing PLC and fantastic PLC have a negative alpha. That is, the expected return is lower than the required return in those cases. In that case, they are overvalued. If they are overvalued, then they should be disposed. All right. Then number two, the shares in which one? E is Elegant PLC. The shares in Elegant PLC is undervalued. Hence, is undervalued. Hence, the securities should be more of it. Hence, more of the securities should be bought. Because it is undervalued, it's selling below the intrinsic value, below the fair value. So what this simply means is that once the price increases in the future, the company will dispose it and make more money. That's interpretation. Number three. What's the name of the third one is G. What is G? G is Godi PLC. The shares, the securities in Godi PLC is properly priced. It's properly, excuse me, is properly valued. Therefore, the shares should be kept. Okay, so that's your interpretation. That should be your advice. This is what the examiner wants you to do. All right. Then finally, you are asked. Examiner is asking you to discuss the factors that a financial manager should consider when investing in marketable securities. Marketable securities are securities or they are investments that can be easily disposed, that are liquid and that can be easily disposed within a year, 3 months, 6 months maximum, or 180 days maximum 1 year. These are marketable security. Examples of marketable securities include the government security like treasury bill. All right. So examiner is now asking you to discuss the factors that a financial manager should consider when investing in marketable security. So you need to put yourself for you to be able to answer this, you put yourself in the position of a finance manager. Okay, say for example, you have idle fund of about 10 million naira. This 10 million naira, you want to put it in a marketable security. What are the factors you need to consider? Number one factor is the initial capital investment. Okay, to answer this, number C, let me just put down 1 or 2 things there. Number C, factors to consider. Number one, like I said, is the capital investments. When you want to invest in marketable security, in a short-term marketable security, you need capital investment, your initial outlay. If you don't have the means for you to invest, there is no way you'll be able to commit. There's no way you'll be able to commit to that cost. So that's number one. Then number two, another factor you need to consider as a prospective investor, the first thing, you need a return. You need to know a return on your investment. Therefore, you are going to talk about the yield. Yield is the return. The higher the capital invested, the higher the yield that you are going to earn at the end of the day. Then, of course, when you talk about capital investments, again, everybody knows what capital investment is all about. Then number three, we talk about the tenor. Tenor is the duration of the investments. Okay, for how long do you want to invest in the short-term marketable security? Is it for 3 months, 6 months, 180 days, or maximum of 1 year? All of this, you need to, your tenor would dictate that. Then number four, you need to talk about the impact of taxation and inflation. The impact of taxation and inflation. You need to know whether inflation. You need to know whether tax and inflation will impact your investments. Okay, you need to know the implication of tax and inflation. Then number five, also you need to consider the impact of foreign exchange. Okay, you need to consider the impact of foreign exchange gyration. Okay. Yeah, foreign exchange. Because if the local currency, if your own currency is volatile relative to the USD, then the value of that your investments may be depressed. All right. So these are some of the factors you need to consider when you want to carry out when you want to invest in the short-term marketable securities. All right. So that is for that. I think it's already, I don't want to go beyond this because of you guys. If you allow me for an additional 30 minutes, then I can solve one more illustration so that we can close this. But I can see one of you has disappeared already, but that notwithstanding, let's call it a day here. And so let me stop sharing this. Tell me, do you have any question for me before I switch to the question? Do you have any question for me so far? Okay, then. So let me wrap it up. Stop sharing this. Share the notes. Now, yes, when you look at the notes, you will see illustration number 8 is the same, it's similar to illustration number 9. It's the illustration number 9 was I think that one was tested in 2021 or 2022. I can't remember clearly. This illustration number 9 was tested in 2021 or 2022. I can't remember clearly. But in any case, it's the same thing with illustration number 8. Very similar to illustration number 8. A, B, C. The same thing the examiner requested for each of them. And the same marks were awarded, except that this one was 15 marks. Then illustration number 8 was 20 marks. Okay. But in any case, you can go and try illustration number 8. Go and try illustration number 8. Okay. Then I need to solve one more illustration. Possibly in our next class, I will solve one more for you where you have correlation coefficient and standard deviation. Okay. So let's call it a day here. Thank you guys for your time. By the grace of God, I will see you next time. Good night, everyone.
Thank you, sir.
You're welcome.